right. Welcome to the Falcon Forward podcast. My name is Peter Brecht. I'm here with our president, Mike Tanghe. It's Tuesday. We're moving our recording schedule around a little bit. And actually, Tuesday, I'm a little more alert and awake than Monday. So if I talk a little too fast, you can slow it down. But anyways, Mike, how are you doing?
I'm doing great, Peter. Great day. I've been traveling quite a bit recently and just enjoying a nice sunny San Diego morning.
I'm still coming down from my 2 week trip 2 months ago. I don't know how you travel so much. I'm jealous of your ability to hop on an airplane so carelessly, or not carelessly, but carefree, I think is the word I'm looking for, right?
Yeah.
Years of practice. But anyways, today we've got some fun topics. We're going to get a little bit, I think, deeper into some insurance conversations than maybe we normally have in terms of purpose and coverage and all that. But first things first, any family news on your side or anything you want to, I guess, share that might be interesting?
Yeah. We were chatting a little bit before and, yes, insurance, that's what we're here doing. But at the end of the day, why do we do all this? It's so we can spend time with family, whether that's extended family. I had the luxury of getting to see my several of my brothers this past week, which has been great. But this morning, minor victories on everything is our youngest has her permit, has her driver's appointment or her license appointment set. She made the appointment for first week in June, and just all these little milestones. So today was her first day of driving to school. Just fun to see her get fired up by, she got out of the car and a couple of the teachers were there. She's like, I just drove to school for the first time. And, teachers
Love it.
shared in her enjoyment. So just quite fun. Also grateful to have made it back in one piece anytime I get in the car with anyone. But yeah, quite fun to see her take on this milestone. And, with all our kids, we raise them to eventually move away from us. And it's exciting when they take each of these steps. So how about news with your family? How are you're a few years back from where we are?
Yeah.
Uh,
I was just gonna make a quick comment. Like, I'm the world's worst passenger. My wife will tell you that. Like, there's only like a few people in life that I'll trust driving, and it'd be her, my brother Derek, and my dad. Other than that, I won't. I don't like people driving. But you get used to it. You got to do what you got to do. But when my kids start to drive, I don't know if I'm gonna be able to do it. Like, I might be my wife doing a majority of that because I'm too much of a control freak when it comes to driving. Anyways, speaking of kids, so yeah, I have a 3-year-old. Lake is my daughter, and then I have a 6-year-old, Braden. And Braden is we are. I'm working on math with him, so it's been kind of my commitment. My wife's doing a lot of the reading stuff with him, but the math side, I really have been trying to help him, like, I guess, get through some of the basics. And what I learned yesterday, so we got this game. It's called Math It, and it's a game I used to play when I was a kid. And basically, you get these flashcards and you put them on a board, and you learn how to like do the colors like based on the difficulty. So, 9 plus 4 is like green, and then you move into blue, which is the eights, and then the sevens, and it gets difficult the color as the color changes. But anyways, we started doing this game, and what I learned was he's like not memorizing things like I would, right? So he learns differently, and that's pretty normal for anybody. But as we kept going, we're like 20 minutes into this, and he's 6 years old. So keep in mind, like, and he's a boy, so he doesn't want to sit there for much longer than 15, anyways. But he likes the game aspect, and he wants to win the game. He wants to get all the way through the most difficult cards. And but what I figured out was like he learned to count to 100 when he was like 2. He could memorize. He went all the way to 100, and then he can go backwards. But he didn't understand what he was actually doing. So when you add one, it's like another unit and then another unit. So we had to like go back to fundamentals yesterday. And the reason I'm sharing this is, first of all, it's exciting for me because I get to unwind like what my son's thinking,
yeah.
how his brain works, and actually kind of like see things. I love seeing his eyes light up when it's like, oh, that clicked. Like, that's the coolest feeling in the world for me. But the other part of it is like, then I sit down this morning with Devin and Maceo, and we start going through our prospecting lists, and it's kind of the same thing. It's like I was able to take some elements of like, how we have all of our leads categorized, and all these things started to like from yesterday started kind of popping up, and like how I was thinking through things was different. So I think there's just so much value, and I don't know, you might get it from kids, maybe you get it from playing chess or poker or whatever, but you can learn so much from like thinking different than you normally would and applying that different ways. So I don't know, it's kind of a nerdy thing to think about, but it's, to me, it's super fascinating when you figure out how your brain's wired,
Yeah.
and what you can pull out of that from other people. So I don't know, it's fun. It's a blast, and kids are fun, but and you seeing those wins is so much. It's a great thing.
Absolutely. Yeah. And you get to kind of share in their enthusiasm and success. And then to your point of like, okay, how do I, I know this, but how do I explain this to a 3-year-old or 6-year-old or a 30-year-old who's learning insurance for the first time? How do I slow down and communicate? Because obviously, if you can't do that, then you're not a very good teacher on stuff. And it's not fair for someone coming up, again, whether it's a newer employee for us or whether it's one of our kids.
Mhm.
So yeah, great lessons and nice. I'll be pulling for Blake's continued success in math. So
Yeah, yeah, absolutely. And it's documented here, so we'll look back in, 6 months is the goal, and yeah, we'll see what the progress is. I'm sure he's going to move along just fine. So,
nice.
awesome. Well, today's topics. There's always M&A going on in insurance and all this stuff, and we're going to set all that to the side. We're going to kind of stay away from the insurance news, so to speak, this week, and
Yep.
talk about product liability and timing and kind of the strategy behind that. So, I'll kind of set the scene for you, and then we can get some feedback. But if you're a company that is, let's say you have a product that you're trying to insure, and that product's not out to market yet, or let's say, hey, I just bought all these a lot of inventory or something like that, and I'm not selling it yet. I'm not doing anything with it, but it's sitting in the warehouse. I don't really want to insure it yet because it's expensive, or I just need the cash flow. So you're kind of staying away from insuring. You already know what's going to cost. You've already gone through the applications, done all that, and you're just like, okay, I don't really want to bind yet. I want to bind in a quarter from now or a couple
Yeah.
weeks.
When do I
How,
start my insurance? Yep.
yeah, yeah. Like when do like I don't know, because I can understand that, right? Like they always say, it's sort of like this podcast. It's a very simple example, but it's like you just have to do it. You just have to start. But it's sort of the same thing when you're starting any new business. Like, okay, I'm ready to go. I'm not ready. I'm not launching yet, so I don't really need to insure. Like, I guess where's that line get drawn?
Yeah. So great questions. It definitely something that in as a business owner, you have to be conscious of this, right? You're trying to match up. I need revenue coming in to, keep everything going here, but I also need to carefully watch my expenses, my money going out. And mismatches of this have brought down a lot of companies, big and small. And so we recently had a conversation with a client about this because, to your point, they'd gone through, they got quotes, and then their thought was, okay, I'm just going to wait and then wait until we start having our product actually in the field before we're going to turn on this insurance because it was a substantial monthly outlay that they were trying to delay as long as they could until that revenue came in on things. So key obviously for any business is, if you're going to get to this point is you have to, put together a business plan. You have to have figured out, okay, what reserves do I need to get things up and running? And then hopefully you're able to either fund that yourself or friends and family is very common, or, for some companies going out to outside investors in letting them know the plan and then getting that money, those commitments from them on it. But some questions to think about that may not be readily apparent, and this is what we talked through with this particular client was, first off, do you have any loans on this equipment that, it's an expensive piece of equipment in this particular case? So have you gotten loans from any banks, lenders, private parties? Because typically with a loan, it will say you must carry insurance. The people who lend you the money to go out and buy something want to make sure that you have insurance coverage if something happens either to this piece of equipment or something happens to a third, someone else gets injured or property gets damaged on it. So that's the first thing to look at is, you got a loan on this? Okay, great. Does that loan require you to carry insurance? Because that may dictate what your timing is. The same type of thing is related to investors. So investors in a company will often say, hey, we'll invest money, but here's what we're going to require to make sure that you have adequate insurance in place. So again, looking at are there any covenants there? It's the thing if on clients. So this is big too. People will come to us frequently and they're super excited because they've been talking to a client for a long time. And the client, said, all right, I'm in, let's do this. We're going to buy your product. But then typically then when those purchase orders or invoices start getting generated, there is a contract that gets put in place, especially for larger pieces of equipment. Um, and guess what those contracts will often say is, hey, I'm going to buy this thing from you, but if it injures someone or damages someone's property, like I want to make sure you guys are insured against that loss because I don't want to take that risk on. I'm the one buying your product. You guys should be standing behind it. And so that can also be tricky too, because we've seen clients come to us and say, "Hey, we signed this contract, and now we got to provide them a proof of insurance that we didn't know we had to do, and the dates don't match up." So, if the coverage isn't in place, obviously there isn't a certificate you can get, and if you put it in place at a later date and your contract's already been executed, that can be problematic because the people come out and say, "Well, can you backdate things?" And these answers, no, you didn't have coverage, and so we can't show that on a contract. The other thing that commonly happens too is, in this client's case, they were looking to match up revenue coming in from the sale and deployment of this product versus it actually, having an exposure. And sometimes people will think, well, I don't have any sales yet, so I don't have exposure. And that's not necessarily true because, are you demoing this product out in the field? Like, are you showing people how it works? Or are you doing any like free trials or anything like that? Or simply like, is it out, being worked on, serviced by a third party? Any of those types of things creates exposure for you as a company. So you got to make sure that, again, you have adequate insurance, even if you don't necessarily have revenue coming in from that particular product. So again, all important things to think about. And the other thing too that we did with this particular client is we got a little bit creative. So we had gotten our quotes, we'd gotten great proposals from a handful of carriers, and then when the client came back, and that was based upon revenue, like what type of revenue was this client anticipating in the next 12 months? And policy period is a defined 12-month period. When the client came back to us and said, "Hey, like we don't want to start coverage here because it's very expensive," what we did is we went back to the carrier and then said, "Hey, here's what they anticipated revenue for the next 12 months. They're actually going to start getting revenue 2 months from now." But so what we did was effectively was we lowered that rating basis, but we were still able to get coverage in place. So they had coverage during that period, but it was just on a little bit more. So effectively they got, in this case, 2 months free of free coverage from what was the agreed upon proposal before. So, and that was
Gotcha.
actually the best win for them. The
Yeah.
last thing that people should kind of think about with this is you don't want to have gaps in coverage. So this particular client did have a policy before, and it was on a much smaller basis. And then this was kind of their ramp up, their next stage of operations. So what we said was, we want that continuity of coverage to be maintained. You don't want to have that gap in coverage because some carriers will just flat out not quote. And the carrier rationale with that is, they want an insurance company is just, it's a transfer of risk. So in agreement for the payment of premium, you have an insurance company that says, "Hey, if something goes bad, we're going to stand up and be the financing for this defense or settlements on it." If you're an insurance company and you obviously want well-funded companies to be your clients, because a non-well-funded company could potentially be cutting corners. And again, insurance companies, they look at that law of large numbers. If you have a pool of well-funded companies and a pool of poorly funded companies, guess who's going to have more claims? It's going to be the ones that aren't doing the right steps as far as it relates to risk management or delaying maintenance or just doing all those little things that if you're forced to, people will do. So when you have that gap in coverage, that's a pretty good indicator of, hey, something's not right with your business. And so a lot of carriers will just say, if that's the case, then sorry, you may be the nicest people or the best product or whatever, but you failed to meet our underwriting requirements. We're not going to work with you anymore. So all very real things that just need to be aware of before you say, "Hey, let's pause or cancel our coverage for a period of time."
Yeah, two notes I have on that. So I think it was like my third week on the job, and I was working on an account with Bill Leversey, and the client had like 12 properties, and 8 of them had lapsed. And he was going to sell one of them. And anyways, we started going through all of it, and I think it came down to the company that he was his previous broker had done a really good job communicating with him. This is the kind of guy, like, he needs a phone call, an email, a text message, and a fax to like know that something needs to be done. But anyways, he had a bunch of lapsed policies, and I will tell you that finding carriers that were willing to take over those lapsed properties was a nightmare. Like, it was like, take a third week on the job person and be like, "Hey, you're going to learn everything about insurance in like a 3-week period." Oh my gosh, it was insane. So if anything, like, lapsed policies are just they're a nightmare on all sides, right? Not just for the broker, but for their client and for the care. I mean, it's the whole thing. And then I guess my question there is, like, there's something called like a no known loss letter, right? So do those work, or are those more for like, "Hey, we just can't, we know there were no losses, the policies weren't lapsed"? Like, what are those used for? Are those not for lapsed policies?
Yeah, no, that's a good question. So a known loss letter is used when there has been a gap in coverage, and it's basically an assurance for, and typically there was some sort of mistake in that situation that someone like didn't pay their premium or a carrier screwed up, or, sometimes it happens on our end as well where but there's a mistake that's been made that coverage that was intended to be in place was not in place. And so what the carriers do, and it's really just for the carrier's file, so that if that underwriter who's agreed to reinstate coverage or backdate coverage, if one of their management or something looks at their file, that letter says, well, here's the situation. Insurance said that weren't aware of it, because if there was, because they're signing a letter saying they're not aware of any claims or anything incident happening, no carrier would ever say, hey, our building's burning right now. We don't have coverage. Can we get things in place right now? Or in this, it happens to us, or we have these conversations. It's more with like lawsuits. So let's say we've talked with someone about employment practices liability coverage, and they've always said, no, we're not going to do it, not going to do it, not going to do it. Multiple instances where people have come back and said, hey, we just, we got an employee who we had to let go, and they told so-and-so that they're going to sue us, or we got a demand letter. Like, can we put that employment practices coverage that we've talked about in the past in place? And the answer is yes, but it's not going to cover this particular instance. They're going to
Right, right.
no loss letters are just when that there hasn't been any claims, and there's some sort of situation that some sort of mistake was made where coverage was intended to be in place. It's not, and it's a way to document that nothing's looming out there that they're about to insure.
We went super deep just now. Thank you for going with that. Yeah, it's like something I didn't, you don't learn about typically until you're far along in the brokerage world. And then and actually there was another comment. So I went to lunch with an underwriter for a reinsurance company, and he lives here in San Diego. And anyways, really cool. Learned a lot about reinsurance that I
Yeah.
never thought about. He works with like, you know, massive real estate portfolios across the world, and anyways, one comment he made was underwriters, people that he works with, like they don't like to rent coverage. So, there's two things is like, okay, we don't want to just feel like, hey, we're getting used this year for a quote and we're going to go to the next one. And,
Yep.
or hey, we're going to be with you for a year, but we have no loyalty. We were going to go move to somebody else. Like on these larger commercial accounts, especially like personal lines, maybe that's a little different. The higher up you go, I think, in what you're spending, it makes a huge difference. But when we're talking commercial accounts. So it kind of along those lines is like, hey, like this is we want to have this coverage in place and kind of continue. You don't want to rent your policy. The idea is that you have it in place for the duration of it. So I thought it was an interesting comment, a different way to think about it than I'd ever heard. But anyways, all right. Our next topic, yeah, our next topic is I think even a little more nuanced than what we just talked about, which is claims management and reserve auditing. So the
Nuance,
first, yeah,
AKA for more nerdy than what
yes, yeah, yeah, exactly. And the first, I mean, this is total cost of risk, or TCOR, I think is what they call it. But I've come across this like looking at doing captive programs. So we talk about this a lot. Is what's the claims history over the last 5 years? That's a typical conversation when you're looking at a captive program fit. If you're going to go to kind of more of a self-insured model, and all that fun stuff. So, but let's get into the auditing claim reserves piece.
Yeah. So where this would come into play is, you have a client that's a larger client where their premiums are impacted by claims. And what do I mean by that? So some smaller clients, they're not expected to have claims. They may have one every, 8 years, 10 years, but it's not really going to impact their pricing. So if they're paying 5 grand a year for coverage and they have a really, really, really big claim, well, maybe their insurance goes up by 500 or 1,000, but nowhere near to recoup what was paid on that. Larger clients, it's a different story because their premiums are directly related to how many claims or what amounts of claims do they have each year, and then how does that look over a historical perspective. And then if you think about it, an insurance company is going to fund those claims, those expected claims. The insurance company has to fund their operations, so their costs for underwriting and billing and claims adjusting, and then they have to have a profit. And that's really how a person's premium is calculated. And if you're in a very competitive market, carriers may try and cut that number down. If it's in what's called a hard market, then carriers will pad that a bit more just because they know that there isn't as much option. So, but by and large, your premiums are determined by how many claims you have if you're a larger business that has a fair amount of claims each year. That's just kind of the basic math on it. So that brings us to the topic of, okay, well, how much are my claims? And obviously, if it's let's say you total a car, pretty easy to say, and no one was injured. It's just your car is totaled. That's a pretty easy claim to adjust. You just go out, what's the value of this car? Here's your check, less the deductible. That claim is done. Literally can take, I'm sure with AI, you could do that, automated within seconds, and that claim is done. But think about it if you have a claim that involves an injury, and either an injury to an employee, which would be a workers' comp claim, or an injury to a third party, which is a liability claim. In those instances, you're not going to know right away what that claim is going to cost. And in some cases, I mean, it literally is years. In some, I've heard some extreme examples of claims that are, 10 plus years in the making as people have continued medical treatment, continued issues. So try to get a determination of what's this thing going to cost it's really an art form. And okay, well, why is all this important? Why can't we just let these things play out? Remember at the beginning how we talked about your premiums are going to be based on what are your claim costs, plus the normal insurance company overhead that they have to have and then profit. And that's what your premiums are based upon. And so what carriers will do then is they'll create reserves for a claim. And what we'll talk about next year, and again, admittedly, you may want to get a big cup of coffee for this one because it's not super it's interesting to some. It's
Yeah.
very technical on it, but it's super, super, super important because if you don't ask these questions and you don't take a proactive approach on it, well, guess who's going to be hurt by that? It's you, the company, the insured, in the form of higher premiums. So claims reserves. So again, you have a bad situation, you have a serious injury of your employee or third party that was injured, car accident or product liability claim. Adjuster gets assigned, and the first thing that adjuster is going to do is say, let me look at the contracts that are in place to see, are we responsible for this? And if so, what degree or what percentage are we responsible? Who are the other parties? Do they have insurance? Like, will they likely participate? Or is it, a foreign company that there's no chance of them, or a company that's gone out of business? An adjuster has to determine what is my client's responsibility in this claim, and then they're going to pick an amount of what they think that claim will eventually settle for, even if it might be years from now. And that amount, that reserve, counts the same as if the adjuster had written a check for that car that was totaled. It's going to have that same bearing on the client's premiums as if it was an actual check paid. So reserves equal claim payment on it. And again, but it's a forecast, that's an arbitrary number. So if you're not drilling down on those reserves, you could be likely paying more on insurance. So what are things you should be looking for is, the beginning is just how did you determine this reserve? You gave me this number, help me understand. And it's, they're going to have a formula that they use. They're going to have factors they use, and just finding out, okay, what is that? How did you come up with this amount? And so first off is you get that detail. Um, and again, it's adjusters, especially ones who've been doing this a long time, which are typically the ones that are on their large liability claims or more complex claims, they'll be very good and they'll be able to justify here's where things came from. But you want to ask them questions, legally, do we think our client's responsible? Will we have the chance to subrogate against another party? What degree do we think our client's responsible? Or asking for medical notes, what is the anticipated recovery time frame for this person? Are they going to need surgery? But finding out really, how did you come up with these numbers? And if it's not well documented, or it's not, they can't justify this, then again, what we're going to push for is for them lowering. And ultimately, all throughout this, each of these steps of the way, we're looking to either get this claim lowered, the reserves lowered, or ultimately get it closed out, because then that's when we have our actuals. Up to that point, it's all just a theoretical piece. And then this, especially for a larger claim, we like to say every 90 days, you should be checking in and asking those same questions. What has changed the last 90 months? Of course, that can be adjusted if we know that, like, next month there's a hearing, or next month there's a mediation settlement or something along those lines. But As a general rule, we should be getting updates every 90 days on what is going on in the absence of something happening faster than that. And then just asking them, what are those steps? What's the timing for the next thing? Well, in 30 days, I'm going to revisit this. And guess who's getting a phone call on the 31st day is going to be that adjuster saying, hey, we talked about this last month. You said you were going to revisit it. And you're not being a jerk or anything like that, but you want to be that friendly squeaky wheel that is keeping things on point, on task. So,
course.
yep. And then, again, is like if this was a employee injury or a third party injury, you'd ask, okay, you said, you allocated a certain amount of the reserves to surgery or to PT or chiropractic care or what. But just asking them, and then as the claim is going on, asking, okay, has this patient been compliant? Are they going to what we've reserved for them to do? And if they're not, then we got to find out why. And is it because the person's better? Okay, well, guess what? Let's cross out those reserves for that. Or if they're not getting better, but they're not doing it, at some point we have to have the adjuster make a decision of if a person's choosing not to get themselves better, then there has to be some finality put on the claim so that we don't have this just open reserve not being spent, but just, moving along and costing our client money. And then if the person is improving, okay, great. Awesome to hear that they're getting better. Obviously, that's the best outcome we want to have is to get that person back to where they were before. But then how will that impact the lowering reserve? So if you're either paying money out or they're getting better, then we want to see that reserve amount going down over time. And then, and this kind of gets back to the beginning, but asking that adjuster, okay, you've set all these reserves. What's our game plan? What's our time frame? And how are we going to get this thing finalized? And then just making sure that they're following that claim plan. Big piece is what's called subrogation. In this, we've talked about this a little bit on some previous podcasts, but do we have the ability to subrogate against the party that may share responsibility or may be fully at fault? Mm-hmm. And if so, then we want to know, okay, yes, there's a reserve here. We want that lowered with the probability that we're going to be able to subrogate. And if, depending on how successful we are in our likelihood of subrogation, like if that's looking better and better and better, then we want to see that reserve going down on it because that reflects, what actually our client is going to have to pay and be responsible for.
Gotcha. So kind of recapping here, is that, reserves are like an adjuster's best guess until you challenge their math. And then the idea there is to have intelligent conversations to either put that to bed and wrap that up or at least understand kind of where the claim sits every 30 to 90 days, I'd imagine.
Yep.
Okay.
Exactly right.
Okay. Okay, perfect.
And then further stuff that continue along is if it's a work comp injury, work comp is going to pay medical bills and it's also going to pay them while they're unable to work. And so a big thing that we want to see anyone with a more serious injury is there light duty work for them available? So meaning
Right.
if their regular job was,
back to work program of some sort.
Let's get them doing something that doesn't require them to risk injury, but still allows them to be working. So, and it's not just finding out is light duty available, but then what's very important is making sure whoever the doctor is that's treating this person, because a lot of times, especially for an employee, this is a confusing process. And you're all these medical terms. You have adjusters, you have doctors, you have all these different people that are talking in a language that you're maybe not familiar with. So we want to be as helpful as possible. So a lot of times, as the employee says, "Well, this is what my doctor says I need to do," and so whatever the doctor says, it kind of becomes gospel on that. We want to make sure that doctor has a description of, hey, here's things this person can be doing that are light duty, but gets them back working and gets them back getting paid. And then statistics show that if you're doing light duty work, you're going to be much faster back to your original job than somebody who's just at home not doing anything. It's just not a good recipe for their mental health. So
sure, of course,
we want to make sure that doctor has a description of the light duty tests available, and if appropriate, is requiring the employee to be doing it. So
gotcha. Okay, real quick, there's two. So we have EMR and we have LCM. And so EMR is the experience modification rate, and then the LCM is the lost cost multiplier. two very distinct terms, but I've seen these on as we're looking at clients and working with them, or and a lot of times you can actually get the information on companies even before you talk to them. It's kind of bizarre how much information's out there on the internet these days. But what are those two things, and why do they matter, or how do they tie into this?
Yep. So great question in that your EMR, your experience mod rate, is specific to um, your business. So you're going to have, and there's companies like NCCI, or each state has bureaus as well, that all insurance companies will report to, and the carriers then determine, okay, if I have X amount of premiums for this particular class code, what is the actual experience for all employers in the state that use this particular class code, as far as what type of claims they have paid? And they use that to determine what's an average. And then they can then take that average against the actual experience of that employer and determine, are you below average, which is actually good, meaning that you have less claims, which case you'll get a credit on your policies, or are your claims history greater than the average, in which case you're going to have a higher EMR rate and pay more. And then the lost cost multiplier is something just the insurance companies use to determine what's the actual pricing that they're going to use on their policies. So taking in what premiums are, and then all the other factors that come into running their company, into how do losses effectively translate into the actual premiums paid.
Yeah, and I was told at one point like that workers' comp is the most vanilla coverage, and the reality is you can get so deep into work comp and like you could build a career out of work comp alone, which and many people have,
Yep.
but it's a very interesting thing to understand in terms of all the things that kind of come into play with it. I think it's very complicated with claims,
Yeah.
but nonetheless, good to have a thorough understanding on it.
Yeah. Um, 100%. And, these next, I have a handful more of points to kind of talk through when
Yeah,
you're looking at claims reserves, and
sure.
really kind of heavily weighted towards work comp claims. Remember, we talked about reserves being an actual forecast of what's going to happen. If it's pretty clearly like 100% our client's fault, and there isn't any chance of subrogation, and there isn't any chance of, is rather than have this one drag on for a very long time, can we offer a settlement? Offer immediate money up front in exchange for having this one done. So sometimes that can, sometimes it kind of depends on the specifics and how expensive it could potentially be on it. That can be a way to get things done kind of quickly. Is, hey, listen, this one, it was an accident, 100% our fault. Let's just get this settled and done with. On a work comp claim, there's something called the compromise and release, or CNR. That's in those instances that I alluded to before, where things are just going on forever and doesn't seem to be any change or improvement. And that's effectively going to that injured employee saying, hey, you're not getting any better. You've been doing this, this, and this. It's not helping. Let's basically offer a settlement to get this one done.
Okay.
And then a release of that claim. Other kind of, called granular details on it is, when you get those reserve amounts from the adjuster, finding out, like, if you're insured as part of MPN, which is like an employer network, it's almost like an internal network, which the benefit has lower rates if people agree to use that, then ensure that they're using those MPN numbers and not just generic, list pricing for calculating costs on it. So that's important to do. If it's a work comp policy, and again, we're concerned about that experience bond factor, that EMR, typically there's a window when you can do that, and it's usually 60 days before the unit stat filing date. Again, kind of a technical term. Rough math would be 6 months or so before a policy renews is when this should be looked at, so that if there are errors or things that can be brought down, reserves that can be brought down, that it's done before that new mod is calculated for that particular
Okay.
client. And then
Gotcha.
the last thing to do with all this, or last recommendation, is just reviewing things on a regular basis to see what has changed, what is going to change, and then how do we keep this thing moving along. So,
Yeah, there's a lot. I mean, when you look at, I think all the things that I don't know, and I know a lot of brokers do this. So I'm not just saying Falcon West, but like when you look at the process and how much goes into the relationship, it really just makes it clear, like, choosing a good team that you want to work with as a broker or account manager, And then, if you're a client and you're running a company, you want to be, have the right people on your team. You might have a fantastic, like, we had a great HR manager. We always did, and like we had an HR in training, right? And we had and there's so much going on. It was like there was always an insurance topic at our monthly meeting, right? It was like that was always an agenda item, was to talk about it. And we managed our risks, I think, fairly conservatively, and we're very careful and did all the things. But it was something we consciously did. And I can say, having sat in this seat, that not every company is maybe doing that, and they need to lean on a broker that can help them a little bit more. And so, anyways, this is, again, we're at the very end of this conversation and kind of going into some deep stuff. What I will do for this particular episode, so for those of you that are listening to this and saying like, man, I cannot follow that, I'm going to go ahead and we'll actually put together like a bullet point article for you to kind of go through, and then a little more in-depth potentially as well. But all these are just great topics that Mike's kind of brought to the surface for us, and definitely something to learn here for everyone.
Awesome. Well, always fun to talk insurance with you, Peter.
Yes.
Insurance and teaching kids math.
Yeah.
So.
Well, it's a great time. So anyways, we'll have this out to you guys. It'll be Wednesday when you get to read it or watch it, whichever you choose. But definitely looking forward to any feedback or comments you have. And Mike, I know we've got other things to do today, but always a pleasure. We'll see you soon for next week.
Sounds great. Thanks, Peter. Really enjoyed it, and have a good rest of your morning.
Thanks all.
Awesome.
Falcon Forward does not provide financial or insurance advice. The following disclosure is available at falconwest.com/privacy-policy. All information provided is for educational and entertainment purposes only. We encourage you to do your own research and consult with qualified professionals regarding your specific needs. If you have specific questions about your property and casualty insurance, our contact information can be found at falconwest.com. This content expresses the views of Falcon West Insurance Brokers, Inc. as of the date indicated, and such views are subject to change without notice. Falcon West has no duty or obligation to update the information contained herein. Further, Falcon West makes no representation, and it should not be assumed that past insurance market conditions, coverage terms, or pricing are an indication of future results. This information is being made available for educational purposes only and should not be used as a substitute for insurance advice tailored to your specific circumstances. The information contained herein does not constitute and should not be construed as an offering of insurance coverage, a guarantee of coverage terms, or a binding quote in any jurisdiction. Certain information contained herein concerning insurance markets, industry trends, and risk performance is based on or derived from information provided by independent third-party sources. Falcon West Insurance Brokers, Inc. believes that the sources from which such information has been obtained are reliable. However, it cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which information is based. This content, including the information contained herein, may not be copied, reproduced, republished, or posted in whole or in part in any form without the prior written consent of Falcon West Insurance Brokers, Inc. To obtain our property and casualty license information, please visit falconwest.com. Our California license number is 0616640.